In the UK, taxes change on a yearly basis. Well, recently it's been a bit more often than that, hasn't it? With Liz Truss and Crazy Kwarteng and all of that stuff going on there. But usually taxes change once a year. And we're going to talk about corporation tax today. Why is corporation tax important at the moment? Well, we've been used to there being one rate of corporation tax, 19%. So you'd pay tax on the profit, it's at 19%, and it doesn't matter whether you're Google, Amazon, Starbucks, whoever it happens to be, you pay tax at 19%, or obviously a rate that's lower than that because they plan to do it, or a small company that pays tax at 19%. But it's 19%, it doesn't change. Well, right now in the United Kingdom, from the 1st of April this year, we have 3 rates of tax. That's right, 3 rates of corporation tax, not 1, 3. You know, it's a bit like you buy one, you get one free, but in the UK, you buy one, you get 2 free. So who'd have thought that? But why is the tax rates important? Well, they're important for 2 reasons. One, there are certain bands that will determine how much tax you pay. And in the United Kingdom, those bands are £50,000, up to £50,000, you will pay tax at a flat rate of 19%. At £250,000 or more, you will pay tax at 25%. Okay, Martin, good. Yeah, but you talked about a third rate. Yeah, a third rate. What happens to the tax rate of that bit in the middle? And that bit in the middle being between 50 and £250,000. Okay, so what tax rate is that? Because that's got to be lower than 25 and it's got to be a bit more than 19, hasn't it? Yeah, sort of. Actually, that tax rate between 50,000 and 250,000 is actually 26.5%. So you go over £50,000 and you're under £250,000, you're going to be paying tax at 26.5% in that band. Oh, hold on a minute, Martin. What? Martin, look, hold on, stop. Why is it 26.5%? Because that just doesn't work. Firstly, trying to get the mathematics to work around that are going to be challenging. My advice to you is if you're trying to work out why it's 26.5% or how they get to that number, don't bother. Just accept that it's 26.5%. The reason that it's 26.5% is because profits between £50,000 and £250,000 have got to move you from a point that you pay tax at 19% to 25%. So you've got to be proportionately moved up the scale to get to 25. So you've got to go from 19 where I start to 25 at the end. What that means is, well, we've got to increase the tax in that band by more than 25 in order to pay more at the bottom end. I know, it's massively confusing. But the point being, you just have to accept that that is the reality. And that reality is going to affect lots of you, if not a more proportion than you think. Profits of £50,000 are actually not that big. If you're a trading company and you've got 3 or 4 employees, you're going to be definitely having a profit of over 50,000 quid. And that means your corporation tax rate is going to go up. It's going to be more than you're used to paying. And you've got to plan and budget for that because the year that we're now in, i.e. the year to 31st of March 24, is the first year that that kicks in. But there's kind of a bit of an added twist in the tail to that. And you go, yeah, okay, but I've got a cunning plan. And I go, good. Is that cunning plan come from the mate that you talk down to the pub every week? Yeah, that's the guy. You know who he is. He's really, really good. And I go, okay, so what's his cunning plan? And he said, well, what I do is I divide my company and I put 50% in one company and 50% in another company. Okay, well, as long as you've done that for good commercial reasons, that's all very well and good. Yeah, good. So that means I get £50,000 in one company, Martin, and £50,000 in the other company. No. So what do you mean, no? No, you don't. That's not the way that this works. Hold on a minute, you've gone off on one again. Why doesn't it work in that way? The reason it doesn't work in that way is that where you have connected companies, and that is defined as somebody that owns both or has more than 50% of the shares of both companies, and those companies are trading, then the rate of tax or the banding is divided by 2 or 3 or 4 or however many trading companies there are. Oh, that's right, Martin, it doesn't matter, the company's not trading. Okay, what do you mean it's not trading? Well, I don't put anything through it. It's just dormant, right? But it's got a bank account. No, it's trading. What? If you have a bank account, your company is considered to be trading, right? And I go, yep, okay. So now you've got 2 companies rather than 3 or whatever many. Well, that means your profit banding is not £50,000, it's 25,000. And the top rate is not 250, it's 125. And when you start talking about multiple companies trading, suddenly the tax rates get very, I don't know, small, or get very large depending on your viewpoint in terms of the rate, very quickly. And you suddenly start going, well, actually, I could end up paying tax at 25%. I've got 4 companies. Right, hold on a minute. That means that the bottom end, I'm going to have tax like £12,500 before I'm paying 26.5%. Yes, you are. But that's nothing. No, it's not. But that's the reality of the tax system that we now have. But if I'm an owner-managed company and it's just me, and my profits are £55,000 a year, is there anything that I can do legitimately to plan to keep my tax down? I.e., can I pay some money out to do something? Yeah, we've talked before about you could buy a car, you could buy computer equipment, you could buy stuff to reduce it by £5,000. Yep, you can do that legitimately. But bear in mind, you've got to keep doing that on a year-by-year basis. Right, okay, but I don't want to... there is only so many computers that I can have. Yeah, get that. Right, so it's not going to work forever, is it? No. But what happens if you put it into a pension? Okay, talk to me about pension. Well, a pension in a company is tax deductible, right? Up to £60,000, right? So you could end up making a contribution into a pension that would reduce your corporation tax amount, not your profits, by up to take you under that £50,000. And then you pay tax at 19%. Can I do that? Of course you can. And what you're doing is you're putting money into your own name for a date in the future, but you're keeping your tax rate at 19%. Right, okay, but that gives me something to think about. Absolutely. And that's the whole point of things like this, is just to go, consider where you are and think what you are. We've not had to worry about tax rates being anything different other than 19%. We've not had to think about profits since 2015. So we've grown up in an era, it's wrong choice of words, but in a time period where that's not been important. It definitely is now, and it's definitely important for the majority of small businesses because they're going to have profits that are more than 50 and less than 250. And that's where it becomes critical to try and plan what's going on and why. Because if you plan for it and you take tax as a cost, which you can manage, it makes it much easier to deal with when you first have to write that check out. So we're talking about how we can reduce tax and how we can keep our profits under £50,000. So why not check out our videos about pensions or about buying cars or assets to see the best ways of doing that.